The Fed has absolutely no idea what they're going to do at this point. They're saying that they're going to rely on the data. I understand what that means, but if you look at other countries and what they're doing, we have inflation in Turkey right now of near 80%. Because inflation in this country has dropped down to 8.5% from that 9.1, 9.2 number, whatever it was, that is making everybody extremely comfortable, especially the Fed. Now, we do have certain Fed presidents, namely Mary Daly, who's rather dovish. They use the term dovish for less aggressive, hawkish for more aggressive on interest rates. Mary Daly is more dovish. You have James Bullard. He is more hawkish. You have Neil Kashkari. He's kind of in the middle, leans to that more dovish end, but he is now coming out saying, guys, the fight against inflation is not over. And I think a lot of what we need to take away with inflation is look at the number that came out last week with the CPI number. Food was still up. Transportation was still up. Medical bills were still up. Everything was still up. There was one specific area that was not up, and that was energy, gasoline. You are paying less at the pump. Now, the reason that you are paying less at the pump, you have to look at different factors of that. Is it because because oil prices are truly dropping, truly organically dropping, or is there something behind the scenes that's going on? Well, there's something behind the scenes that's going on. We're dipping into the strategic reserves. That's not a good idea. With hurricane season coming up in the South, Georgia, Louisiana, Florida, anywhere, or even up the East Coast, if any type of hurricane happens, you are going to see your gas numbers skyrocket. Secondly, a lot of states out there are still not charging taxes, state tax, for gasoline. So a lot of these factors are bringing down gasoline prices. This is why I'm not comfortable saying, yes, energy prices are coming down and they're staying down. So what is the Fed going to do? They've said right here, during the minutes came out yesterday. That's the reason for this. During a meeting in which the central bank approved a 75 basis point hike. So now interest rates are sitting at, the Fed funds rate is sitting at 2.25 to 2.5%. Now, they are saying that this is a neutral rate. I don't understand how this is neutral. Bill Ackman actually wrote a good piece on this on Twitter. He said, how is this neutral if you have inflation sitting at 8.5%? How does that make this neutral? It doesn't make any sense. Going forward, the next meeting is in September, and it's actually in Jackson Hole. So this is the big annual Fed meeting. They have put everything on the table. They've said that they are going to follow the data, which is probably the smartest decision right now, and not saying, hey, we're going to raise interest rates 75 basis points. We're likely going to raise interest rates by 50 basis points, whatever it is. They've said there are multiple moves still on the table through the end of the year and into 2023. And they don't know what those numbers are going to be. Now, a justification that I have heard lately is that 2.25 to 2.5 number is actually more like 3.25 to 3.5. Now, how is that? Well, you have to remember, what else is the Fed doing? They are quantitative tightening. They are not only raising rates, but they're quantitative tightening, meaning that they are stopping buying these mortgage-backed securities and treasuries. So in doing that, people are saying that this is giving the Fed an additional indirect way of having the interest rate set at this 3.25, 3.5 number. Do I actually agree with that? No, not at all. It doesn't even make any sense. But that's what they're doing. So next 2 months, what do I expect to happen? If there's no natural disasters happening, I do think you're going to keep seeing these energy prices coming down. And I think it's going to be for the same reason: strategic petroleum reserves and the different taxes that are coming down state to state. As far as what the Fed's going to do, I think going into the next meeting, depending on that inflation number, you are going to see some type of 0.5 point to 75 basis point increase. Going further than that, who knows? That's, I think, when they're truly going to begin viewing the data and saying, this is what we were going to do from here. It has been said they still want to have target inflation sitting at 2%. I don't know why they're fixated on this number and why they haven't increased it. I mean, I would think that a healthier inflation point would be 3% to 3.5%, but that's just me based on history. They are fixated on this 2% number, and they want to get this to that 2% neutral number. So They do not want to get too far away from that number. If they do get too far away from that number, they're going to have to aggressively cut. At the same point all of this is happening, I think that the Fed does not want stocks to keep going higher. It's okay if they trickle higher like this, but I think what they would rather have, because if the demand needs to slow, it absolutely needs to slow. I think that if they would be more comfortable with a very slow decline in stocks that would actually help solve this inflation issue, solve the demand issue, solve some of this supply chain issue that is still absolutely out of control. Don't forget, we haven't seen ramifications of COVID yet. Shutting down the global economy. You still have not seen those ramifications, I promise you that. So, in the end, what should you do? I don't think you should deviate from depending on what the Fed is going to do. The Fed has very little credibility right now. A lot of central banks in the world have very little credibility right now. You have Turkey. I read a story on the morning show this morning. Turkey has nearly 80% inflation, and they are beginning to cut rates right now. Granted, it's from 14% to 13%, but they are cutting rates right now. It does not make sense. Nobody is getting aggressive with inflation. With that being said, my name is Mo. Paul and I are value investors. On this channel, we've made over 1,700 videos that range from value investing, options, topics like this, trading. The list goes on and on. We are an education channel. We want to teach you guys things. We want to just make you understand the world better, make you become better investors, make you become investors at all. Guys, going forward with this, where we are in the market right now, I don't necessarily think, I think this is a bear market rally. We've seen this before. We saw this in 1929. This is something that happened. You had a big rally. Go and look at Michael Burry. Well, if he didn't delete them, but you can go and Google Michael Burry's tweets because he does these cryptic tweets or he deletes them. 1929, 1930, you had the .com in 2000. You had the financial crisis in 2009, 2011. You can go and look at. You had these crazy rallies after these big drops. This bear market that we were just in. Technically now we're in a bull market, but the bear market that we were just in, that was the longest bear market since this time back in the financial crisis. That's not a very long bear market. The other one was COVID. I don't even count that one because it was a fast drop and an even faster recovery. Where are we in this market cycle? I think this is some type of little bear market rally, and I don't think that the news of where we are with interest rates, where we are with inflation, where we are with credit card spending. In the second quarter of this year, we had the most credit cards opened ever. You have people out there like Jim Cramer saying that people are spending more and people are spending in cash. They are not spending in cash. They are taking out more and more and more debt. You are starting to see these the credit spreads were starting to raise. 8 to 15 is when it gets scary. They raised up to 5. They came back down to about 4, and people are thinking that things are okay again. This could be the calm before the storm. I really don't know. But we were just talking about this here. There's a guy on Instagram that you have to go and watch. This guy, this is the person that, let's see, Justin A-W-A-D and the number 1. You have to go and watch this kid on Instagram. He asks people extremely basic questions. Who is the president of the United States? Somebody said George Bush. What is 77 plus 23? 121. What is 3 times 3 times 3? 18. The guy says 3 times 3 is 6 times 3 is 18. Okay, whatever. The point is, I think this is a lot of the people that that are investing in stocks right now. They're only looking at the numbers in the market going up and down. They are not looking at anything else. Once people start realizing this, and once stocks start getting hit, I don't think that those people are ever going to realize the numbers. They don't care about the economy. Once stocks start coming down and people think, hey, I can't make money in stocks anymore, stocks are not the place to be. It's going to be real estate. It's going to be this. It's going to be that. You cannot make money in stocks. This is what we heard in 2000. This is what we heard in 2008. That is exactly when you are going to start to see the slow trickle. And I don't think that the market is going to come straight down. This is not healthy. You need to have a decline like this, a very, very slow decline over a long period of time. Actually, it probably spans the whole board. It's something like this that happens for a very, very long time. You do not want that straight decline. That is not how, that's what COVID did. And you saw that it wasn't sustainable. A big drop leads to a super V-shaped recovery. No matter what happens, We think that recessions are a really great opportunity. Recessions are not some scary thing where the world is just going to end. Watch this video right here with Paul. He'll explain it to you. Catch you on the flippity flop.